This is Wallet Brief, where we break down what actually moved the U.S. economy this week, without the noise. If prices, interest rates, jobs, housing, or taxes are quietly changing your money, this is where you stay informed. Let's get into what really happened this week, and what it means for your wallet. Over the past year and a half, Americans watched the Federal Reserve execute one of the most aggressive interest rate campaigns in modern history. After raising rates to a peak of 5.33% in 2023, the Fed began cutting in September 2024. 3 consecutive cuts brought the rate down to 3.5 to 3.75% by year-end. Markets expected that easing cycle to continue through 2026. Forecasters predicted 3 more cuts this year. Mortgage rates fell steadily, reaching their lowest levels since 2022. But January brought mixed signals. Inflation ticked back up to 2.9%. Job growth stayed strong. And at the late January Fed meeting, the central bank paused. No cut, no hike, just a wait-and-see stance. The question became, is the easing cycle over, or just delayed? This week, the market answered that question forcefully. On Wednesday, the Bureau of Labor Statistics released a shockingly strong employment report. Job gains far exceeded expectations. Treasury yields surged immediately. 2-year yields jumped 9.5 basis points, and 10-year yields climbed to 4.17%. Traders slashed their expectations for Fed rate cuts this year. Markets now price in just 1 or 2 cuts for all of 2026, down from 3 cuts expected just weeks ago. Some economists believe no cuts will happen this year. Meanwhile, mortgage rates responded positively despite the turmoil. The 30-year fixed rate dropped to 6.09% this week, the lowest level since 2023. The 15-year rate fell to 5.44%. And in a sign of what's coming, President Trump officially nominated Kevin Warsh as the next Fed chair to replace Jerome Powell when his term expires in May. Warsh is traditionally seen as more hawkish, though analysts debate whether he'll push for faster cuts under political pressure. The bigger picture shows a Federal Reserve stuck in limbo. The central bank wants to cut rates to support the economy, but inflation remains stubbornly above the 2% target and job growth is too strong to justify easing. This isn't a temporary pause, it's a structural problem. The so-called last mile of disinflation is proving harder than anyone expected. At the same time, the Fed is facing internal division. 2 governors, Stephen Moran and Christopher Waller, openly dissented at the January meeting, voting for a cut. That level of dissent is rare and signals growing frustration with the holding pattern. Moran has argued that rates are too tight and that the neutral rate, where policy neither speeds up nor slows down the economy, is lower than the Fed thinks. Looking ahead, the Fed is unlikely to cut before mid-year at best, and possibly not at all in 2026. The signal is clear. Interest rate relief is stalled, and it's not restarting anytime soon. For your household, this week's developments have both good and bad implications. If you're borrowing, you're stuck with high rates for longer. Credit card rates remain elevated, personal loans are expensive, and car loans are pricey. The good news is for homebuyers and refinancers. Mortgage rates at 6.09% are the best in 3 years. If you've been waiting to buy or refinance, this is the window. Rates here are over a full percentage point lower than they were a year ago. For savers, the news is better. High-yield savings accounts and CDs are still offering competitive returns, often above 4%. If the Fed doesn't cut rates soon, you'll keep earning those high rates on your cash for months. But if you're carrying debt, the extended high-rate environment is painful. Every month you pay more interest on balances that aren't shrinking fast enough. The practical takeaway is this. Lock in low mortgage rates if you can, maximize your savings returns while they're high, and aggressively pay down high-interest debt because relief isn't coming. Next week, watch for the next PCE inflation report on Thursday, February 20th. That's the Fed's preferred inflation gauge, and if it comes in hot, expect markets to fully price out any rate cuts for the first half of 2026. Also watch Treasury yields closely. If the 10-year stays above 4%, mortgage rates could reverse their recent drop. On the political front, pay attention to Kevin Warsh's Senate confirmation hearings once they're scheduled. His views on rate policy will give clues about what happens after Powell's term ends in May. And keep an eye on Fed speeches. If more governors start dissenting publicly or calling for cuts, it could signal a shift. Finally, if you're in the market for a mortgage, don't wait for rates to drop further. The current 6% level is as good as it's been in years, and there's no guarantee it stays this low. The data tells you the Fed is on hold. Next week's signals tell you if that hold becomes permanent. That's your wallet brief for this week. These changes don't always make headlines, but they do change how much you pay, save, and earn. We'll be back next week with the updates that matter. Until then, stay informed and protect your wallet.